A car dealership is one of the largest, most visible pieces of real estate in any town. Acres of prime frontage on the busiest road, a gleaming showroom, rows and rows of inventory. But here's what most people miss. For an investor, the real money was never in selling the cars. It's in owning the ground they sit on. Here's the economics of dealership real estate and why net lease investors have quietly fallen in love with it. Start with what you're actually buying. A franchise dealership is a small campus, a showroom, a service department with a dozen or more bays, a parts warehouse, and a sprawling display lot. It sits on some of the most valuable retail dirt in the market. High traffic counts, easy access, and enormous visibility. This is real estate that would be expensive and difficult to ever replace. The footprint is substantial, 2 to 10 acres or more, with a building running 20 to 60,000 square feet between the showroom and the service shop. High replacement cost is a feature, not a bug. It protects your downside and makes the asset hard for a competitor to duplicate down the street. You're buying scarce, well-located commercial land with a big improvement on top. Now, how does an investor actually get to own this? Through a sale-leaseback. Running a dealership ties up enormous amounts of capital in inventory, in real estate, in working capital. So dealers increasingly sell their real estate to an investor and simultaneously lease it back on a long-term net lease. The dealer frees up millions in trapped equity to grow. The investor gets a stable, long-term tenant on irreplaceable dirt. Here's the elegance of the structure. At the same closing, the dealer becomes your tenant under a brand new long-term lease, typically 15 to 20 years or more, absolute triple net. The operator keeps running the exact same business they always have. Nothing changes for the customer. You simply collect rent on a property the tenant has every incentive to maintain because their livelihood depends on it. And the tenant's business is more durable than it looks. Dealers make a surprising share of their profit not from selling cars, but from what the industry calls fixed operations, service, and parts. That recurring repair revenue can be around half of a dealer's gross profit, and it holds up whether car sales are booming or slumping. A tenant with sticky, recession-resilient income is a tenant who keeps paying rent. The lease itself is structured to be about as hands-off as commercial real estate gets. Dealership sale-leasebacks are typically absolute triple net. The tenant pays the rent, the taxes, the insurance, and every dollar of maintenance. Roof, parking lot, building, all of it. As a landlord, your job is essentially to deposit the check and watch the rent escalate over time. Initial terms run 15 to 20 years and beyond, with rent that steps up steadily over the life of the lease. The strongest deals are leased to the large public dealer groups, names like AutoNation, Penske Automotive, Lithia, and Group 1, operators that run hundreds of stores and carry real financial strength behind the guarantee. As always, the lease is only as good as the company standing behind it. Pricing tracks the strength of the operator. Real estate leased to a large, publicly traded dealer group trades around 5.5 to 6.5%. A strong regional operator pushes 6.5 to 7.5. Independent or used car operators carry more risk and trade higher. These are larger assets, typically $5 to $30 million or more, which makes them a target for serious 1031 buyers and institutions. This is where discipline pays off. The brand on the building, the manufacturer, is not who pays your rent. Your rent comes from the operator who holds the franchise and signs the guarantee. A national group running hundreds of rooftops is a fundamentally different risk than a single store independent owner. Study the operator's financial strength, the length of the lease, and the strength of the guarantee before anything else. Now, the risk you have to weigh, the industry is changing. Some newer manufacturers sell directly to consumers, bypassing the franchise dealer model entirely, and electric vehicles need somewhat less service over their lives. But put it in context. Franchise laws in most states still protect the dealer model. Legacy automakers continue to sell through dealers, and EVs still need tires, brakes, software, and bodywork. The smartest operators are already building EV sales and service into their stores. And never forget what sits underneath the lease: a large premier parcel of commercial land. If the use ever changed, those same acres of highway frontage are exactly what a developer wants for retail, multifamily, or mixed use. That redevelopment optionality is a powerful safety net. You own land that has value far beyond its current tenant. In a high growth state like Florida, that optionality only compounds over time. Putting it together, dealership real estate is a large format, long lease, net lease play. Sticky tenant income from service and parts, absolute triple net terms, irreplaceable land with redevelopment upside, and pricing that ranges from 5 into the tens of millions. It rewards investors who underwrite the operator's credit and the strength of the location, and it's a natural fit for a sizable 1031 exchange or a long-term institutional hold. Car dealerships prove that the most valuable thing on the lot is often the lot itself. The economics reward investors who understand sale leasebacks, operator credit, and the long-term value of irreplaceable land. If you're evaluating dealership real estate or net lease sale leasebacks in Central Florida, that is exactly what we do at MaxLife Commercial. The link to connect is in the description.